Hey everyone, welcome back to the channel. If you're new here, I'm your go-to guide for mastering real estate finances. Owning rental properties is an incredible way to build long-term wealth, but navigating the tax landscape in the USA can be a real challenge. So whether you're a seasoned landlord or just starting out, stick around because the tips I'm sharing today could save you thousands of dollars. Let's dive in. Alright, let's break down this term income from house property, because it's not as simple as it might sound. Essentially, this term covers any income that you generate from renting out a property. It could be a house, an apartment, a commercial building. If it's a property that you own and are renting out, it falls under this category. Even if your property is vacant but available for rent, the tax rules still apply. The IRS considers the potential rental income you could be earning. This is why it's crucial to understand the ins and outs of how this income is taxed, so you're not caught off guard come tax season. By understanding the rules of the game, you can make informed decisions that benefit your bottom line. Now, let's get down to the nitty-gritty. How exactly is this income taxed in the USA? Don't worry, I'm not going to bombard you with jargon and complicated formulas. First, we need to determine something called the gross rental income, or GRI, of your property. This is basically the rent you receive from your tenants. Then we deduct allowable expenses like property taxes, insurance, and maintenance costs. From the remaining amount, you can also deduct depreciation, a percentage of the property's value over time. And finally, if you've taken out a mortgage for the property, you can deduct the interest you're paying on that loan. After all these deductions, what you're left with is your taxable income from the property. Now, who doesn't love a good tax deduction, right? In the United States, you can deduct property taxes you've paid on your rental property. Next, the mortgage interest you pay on your rental property is also deductible. This can significantly reduce your taxable rental income. Don't forget to keep all your receipts and documents organized. Another major deduction is depreciation, which allows you to deduct the cost of the property over several years. These deductions can make a significant dent in your tax liability, helping you save big. Okay, let's talk about some common mistakes people make, because believe me, I've seen them all. One of the biggest blunders is simply forgetting to declare rental income. Look, I get it, taxes can be confusing and it's easy to overlook things. But trust me, you don't want to mess with the IRS. Another common mistake is not keeping proper records. Remember those receipts I mentioned earlier? Yeah, those are crucial. You need to be able to back up your deductions with solid proof, or the tax authorities might come knocking. A lot of landlords miss out on deductions they're eligible for, simply because they're not aware of them. So it's crucial to stay informed and make sure you're claiming everything you're entitled to. So there you have it, a crash course on income from house property and how it's taxed in the USA. Don't be afraid to seek professional advice from a qualified CPA. They can guide you through the intricacies of the IRS guidelines and ensure you're maximizing your deductions. Stay informed. Subscribe to this channel for more valuable insights on real estate, finance, and of course taxes. Now, I'm curious. What are your biggest challenges when it comes to rental income and taxes? Let me know in the comments below and let's get a conversation going. Alright guys, that wraps up today's video. I hope you found this breakdown helpful. Remember what I always say, knowledge is power, especially when it comes to your money. If you found this video helpful, don't forget to smash that like button and subscribe to the channel for more USA-specific real estate investing, personal finance, and of course, more tax tips. Thanks for watching, and I'll catch you in the next one.